Today, we will take a closer look at Alphabet, the world's leading company in online search, digital advertising, and cloud infrastructure, and the parent company of Google, YouTube, and Google Cloud. In the fourth quarter of fiscal year 2025, Alphabet delivered strong financial results, with quarterly revenue reaching $113.8 billion, up 18% year-over-year, driven by a solid recovery in advertising and exceptional growth in Google Cloud. Advertising remained the largest contributor, with search continuing to serve as the core revenue engine, supported by resilient user intent and advertiser demand. Meanwhile, Google Cloud further expanded as a key growth driver, fueled by accelerating AI adoption and rising demand for data infrastructure. In terms of profitability, Alphabet reported gross profit of $68.1 billion, representing a gross margin of 60%. Operating income totaled $35.9 billion, while net income reached $34.5 billion, highlighting strong operating leverage even as the company continues to invest heavily in AI. EPS came in at $2.82, slightly above market expectations, underscoring Alphabet's solid earnings power. Looking at the trend from 2021 to 2025, Alphabet's total revenue increased from approximately $55 billion to $113.8 billion, more than doubling over the past 4 years, underscoring strong and sustained long-term growth. Google Search remains the core revenue pillar, generating $63.1 billion in Q4 2025 and accounting for more than half of total revenue. With a CAGR of around 13.4%, Search continues to demonstrate the durability of intent-based advertising and its strong cash-generating capability. YouTube ads reached $11.4 billion, delivering steady growth with a CAGR close to 10%, while Google Network declined modestly with a negative 5.7% CAGR, reflecting advertisers' gradual shift toward owned and direct platforms. Most notably, Google Cloud is the fastest-growing segment, with an impressive 47.6% CAGR, reaching $17.7 billion in the latest quarter. Cloud is increasingly emerging as Alphabet's next growth engine, driven by AI adoption, rising data infrastructure demand, and global digital transformation. Meanwhile, subscriptions, platforms, and devices maintain solid momentum with an 18.4% CAGR, reinforcing Alphabet's strategy to diversify revenue streams beyond advertising. In the global digital advertising landscape for 2026, Alphabet is projected to maintain its leadership position, with total advertising revenue expected to reach approximately $229.4 billion, primarily driven by Google Search and YouTube. However, Alphabet's market share is gradually declining, from nearly 30% in prior years to around 26.4% in 2026 and approximately 26.1% in 2027. This moderation reflects intensifying competition from platforms such as Meta and ByteDance, TikTok, as well as the rapid rise of new AI-driven formats that are reshaping ad spending allocation. Meanwhile, the global digital advertising market is projected to reach about $869.4 billion in 2026 and $944.4 billion in 2027, up from roughly $797.4 billion in 2025. Despite slight share compression, Alphabet continues to grow in absolute terms and remains one of the primary beneficiaries of the long-term expansion in digital advertising worldwide. Next, we take a closer look at the core drivers behind Google Ads growth in 2025 and the forces that could sustain momentum in the coming years. In terms of scale, YouTube generated over $60 billion in revenue in 2025, including ads and subscriptions, while YouTube Shorts reached 200 billion daily views, solidifying short-form video as strategic ad inventory. Meanwhile, search ads grew 17% year-over-year, reflecting the clear impact of AI integration. At the core is the AI Power Pack. Demand Gen creates new demand across Shorts, Discover, and Gmail. AI Max for Search optimizes keywords and landing pages in real time. And Performance Max automates cross-channel campaigns with a focus on conversions and profit. Gemini 3 is deeply integrated into Google Ads, enabling conversational campaign creation and AI-generated creatives, driving 12 to 22% higher CTR versus traditional assets. Finally, the shift from ROES to POES, alongside global expansion of consent mode v2 and first-party data strategies, positions AI as the central engine of Google Ads' long-term growth and profitability. Streaming's share of total US TV viewing time has increased significantly, rising from around 36% in early 2024 to nearly 47 to 48% by the end of 2025. According to Nielsen, streaming has officially surpassed the combined share of cable and broadcast TV, signaling a structural, long-term shift in consumer viewing behavior. Among streaming platforms, YouTube has emerged as the clear leader, accounting for approximately 12.7% of total TV viewing time by late 2025, up sharply from 8.6% in early 2024. This puts YouTube well ahead of competitors such as Netflix and Prime Video. YouTube is no longer just an online video platform. It is increasingly becoming the new TV in household viewing habits. Strategically, this leadership translates into a powerful advantage in connected TV, CTV, advertising inventory, as ad budgets continue shifting from traditional TV to digital platforms. With massive scale, rich first-party data, and AI-driven targeting capabilities, YouTube is one of the primary beneficiaries of the ongoing transition to streaming, reinforcing its critical role in Alphabet's long-term advertising growth. A few years ago, Google Cloud was still a heavy investment business with limited profitability. By the end of 2025, the picture had changed meaningfully. Quarterly revenue increased from around $4 billion in 2021 to $17.7 billion in Q4 2025, while operating profit reached $5.3 billion, signaling that Google Cloud has moved beyond the scale-up phase and is now benefiting from operating leverage. On the market side, Google Cloud holds approximately 14% global cloud infrastructure market share, up from around 9% in 2021, within an industry that surpassed $400 billion in revenue in 2025, with Q4 spending reaching $119 billion, up 30% year-over-year, driven by AI demand. While AWS remains the leader with 28% share and $35.6 billion in quarterly revenue, growing 24%, and Azure holds 21%, Google Cloud is growing faster and increasingly benefiting from multi-vendor strategies, as enterprises seek to avoid full dependence on a single cloud ecosystem. When Gemini was first launched, it faced skepticism in an intensely competitive AI chatbot market. Its market share declined at one point as Google worked to refine the model and improve user experience. However, with major upgrades such as Gemini 3, which significantly enhanced reasoning capabilities and multimodal performance, combined with deep integration into search and the broader Google ecosystem, growth momentum has clearly returned. As a result, monthly web traffic surged from approximately 284 million visits in early 2024 to over 2.0 billion by early 2026. In terms of web traffic share among AI chatbots, Gemini now accounts for roughly 21.5%, reflecting growing user adoption. In the US market specifically, Gemini maintains about 15% AI chatbot market share, indicating recovery and stabilization after the initial adjustment phase. At the same time, the Gemini app has reached 750 million monthly active users, adding 100 million users in just one quarter, demonstrating rapid expansion on mobile. On the infrastructure side, Gemini is now processing approximately 10 billion tokens per minute via API, while serving costs declined by 78% in 2025, providing strong operating leverage to support further scale and monetization. Alphabet 2026 is a very large strategic bet. After surpassing a record $400 billion in revenue in 2025, the company is entering the most aggressive infrastructure investment cycle in its history, with CapEx projected at $175 to $185 billion in 2026, nearly double 2025 levels, aimed at securing long-term leadership in AI. The core of this investment is silicon sovereignty, building hardware independence to reduce reliance on NVIDIA, especially as future AI costs will be increasingly driven by inference rather than training. With TPU v7 Ironwood, Google targets comparable raw performance, around 4.6 flops FP8, while delivering 30x better total cost of ownership per token, a critical advantage for protecting margins as AI scales. Beyond infrastructure, Alphabet is pushing agentic commerce through the Universal Commerce Protocol, UCP, an open standard that enables AI agents to move seamlessly from discovery to checkout via Google Pay, supported by partners such as Shopify, Walmart, and Etsy. Early 2026 data shows that merchants adopting UCP can achieve up to 28% higher conversion rates, signaling a potential pivot of search from answers to transactions. Within other bets, Waymo is reaching commercial maturity, now running over 400,000 paid rides per week and valued at approximately $126 billion following a major funding round. This reinforces the view that beyond ads and cloud, Alphabet holds meaningful long-dated option value. Finally, risks remain. The DOJ continues to pursue structural remedies, including discussions around potential divestitures of Chrome or Android, while in Europe, publishers are pushing back against AI overviews for diverting traffic. These regulatory pressures could weigh on search, just as Alphabet accelerates its largest AI investment cycle to date. Looking at Alphabet's operating expense structure in Q4 2025, the company clearly prioritized research and development spending. Research and development expenses reached $18.6 billion, up roughly 90% compared with 2022 quarterly levels of around $9 to $10 billion, implying an average annual growth rate of about 21 to 22%. The sharp increase in Q4 was driven by accelerated artificial intelligence investment, including Gemini model development, custom TPU chips, and cloud infrastructure expansion. In contrast, selling and marketing expenses grew much more slowly, at approximately 4 to 5% per year, indicating that Alphabet continues to drive growth primarily through product and platform strength rather than marketing intensity. General and administrative expenses remained largely flat, increasing by only around 1 to 2% annually, highlighting strong cost discipline even as artificial intelligence investment scaled rapidly. While revenue has grown steadily quarter after quarter, net income has been more volatile. After falling to a low of approximately $13.6 billion in Q4 2022, mainly due to weakness in the global advertising market and rising cost pressures, profitability began to recover meaningfully from 2023 onward. By Q4 2025, net income reached $34.5 billion, more than 2.5 times higher than the 2022 trough, indicating that Alphabet's earnings power has been largely restored. Net margin also expanded significantly. From a 17 to 20% range in 2022, margin surged to 38.3% in Q1 2025 before stabilizing around 30 to 34% in subsequent quarters. This margin expansion was primarily driven by strong growth in Google Search and Google Cloud, operating leverage as quarterly revenue exceeded $100 billion, and continued cost discipline despite heavy investment in artificial intelligence. From fiscal year 2022 through fiscal year 2025, Alphabet's reported revenue has generally tracked closely with market expectations, indicating strong stability and forecast visibility across its core businesses, particularly search and YouTube advertising. Looking ahead to fiscal year 2026, consensus estimates suggest that quarterly revenue is likely to remain above $110 billion, translating into full-year revenue of approximately $470 billion. This outlook is supported by AI-driven improvements in advertising performance, steady growth in subscriptions, and continued expansion in Google Cloud. Notably, Google Cloud's AI-related order backlog has increased by around 55% to approximately $240 billion, further improving revenue visibility over the medium term. In contrast to revenue, earnings per share have exhibited greater sensitivity to investment cycles, primarily due to elevated spending on artificial intelligence infrastructure. Based on current consensus, earnings per share for fiscal year 2026 are projected at around 11.4 to 11.5 USD. As operating leverage improves and higher margin businesses, particularly cloud and services, continue to scale, incremental revenue is expected to convert more efficiently into profit, allowing earnings growth to modestly outpace revenue growth over the medium term. Although Alphabet's long-term outlook remains compelling, underpinned by a rapidly expanding Google Cloud backlog, improving search monetization driven by artificial intelligence, and YouTube's growing scale in digital advertising, the stock may encounter near-term consolidation after more than doubling over the past 10 months. In addition, the current elevated capital expenditure cycle could temporarily weigh on margins, even as it reinforces the company's long-term competitive positioning. Based on estimates from 64 analysts, Alphabet's average 12-month price target stands at $375.7 US, implying approximately 22% upside from the current level near $309 US. The bull case target reaches $443 US, while the bear case target is $273 US, indicating a favorable risk-reward profile with limited downside relative to potential upside. Analyst sentiment remains firmly positive, with a vast majority of coverage maintaining strong buy or buy ratings and no sell recommendations. Thank you for watching. The information presented in this video reflects opinions at the time of publication, is based on sources believed to be reliable, and is provided for informational purposes only. It does not constitute investment advice or a recommendation.